Hi, everybody. This is Kirk Davis with CAMPS, the Center for Advanced Manufacturing. I'm here today with Brenda Sanchez from the Washington Small Business Development Center, or SBDC. So, Brenda, it is a pleasure to have you here today. Brenda and I were just getting more acquainted just before the call and found out that we kind of have a lot in common. In a previous life, worked at the WSBDC and really enjoyed my time there. So I have an understanding of the demands on her. And we were both in the Army, probably different times and different type of assignments. But we also both have our bachelor's degree from the University of Hawaii. And so the more we talk, it's like, oh my goodness, we have a lot of experience in common.
Yeah,
So Brenda, welcome. It is so nice to have you here to talk to the manufacturers today.
thank
Uh,
you. It's wonderful to be here.
I want to mention that in addition to you're a certified business advisor
Mhm,
with the SBDC, but you also have a CPA in your
mhm,
background.
mhm,
And you and I were just talking that in your current role, you really cannot give tax advice or
mhm,
legal advice to your clients.
mhm,
However, you have a really strong financial background. And
mhm.
I came from banking and I have this strong financial background. So we thought that today we would talk about a topic of for manufacturers is how to be bankable. Because
Mhm.
one of the things that funds that I've seen really initiate growth in manufacturing is the ability for manufacturers to get funding from banks.
Mhm.
There's other ways to get funding, but bank money is the cheapest money, I think, the best money.
Mhm.
So anyway, Brenda, I'm so excited to meet you and to have this opportunity to talk to manufacturers today about being bankable. So go ahead and tell us, Brenda, a little bit about your experience. How long have you been at the SBDC now?
Sure. So I started full time at the SBDC in May of last year. Yeah.
Okay.
So it's been a little over a year. Since then I've completed the certification because there's that 6 month certification process. And yeah, it's kind of gone by so fast.
Yeah, and I really enjoyed my work there because the business owners you get to work with are great. And the SBDC provides technical assistance, which means you can take them any problem. And you have a network, and I'll just mention there's 33 offices throughout the state of Washington. So chances are there's an SBDC office near you, and there's more than 40 certified business advisors, and they network together on problems. So if you talk to Brenda and you come up with something that's difficult or she hasn't encountered it before, she's got these 40 other people to help find solutions. And so the SBDC can be a great help. And Brenda, is it okay to say how much you charge for technical assistance?
It's no cost to you. We're funded. Well, my office specifically is funded by the SBA and Washington State University. So
Yeah. So they are funded to help businesses at no charge, which is incredible. And I know you'll enjoy the experience of getting to know Brenda, and to have these type of conversations can be so helpful. So let's talk a little bit because we both understand the importance of bank financing. Uh, what do we mean by being bankable? Do you have any good working definition for that?
it's basically the credit worthiness of the company, and it's being bankable means being a low risk to lenders. So your financials are good. I can go into a little more detail.
Yeah,
Would you?
we will. This is
Okay,
a
good.
technical session. We're gonna kind of dive deep because we're both good at this. But yeah, and I think of strong financials, but usually with positive trends.
Yes.
And the
Mm-hmm.
the problem that I understand because of the way the economy has gone the last several years, yeah, maybe 3 4 years, it's not been easy for manufacturers to maintain a positive trends in their revenue and their earnings and other measures that the banks looks at. So let's just talk for a moment about some of that basic financial criteria. What are the banks looking at? And I really like what you said that your company, from the bank's point of view, has to present a low risk because in return, there is an interest rate, but they're not charging you equity like other forms of funding, like a venture capital or an angel or private investor or private equity, they'll come in, sure, but then they want equity for that, where the bank says, here's an interest rate, but we don't need the equity. But in return, we want to present very low risk to the bank.
So positive financials, obviously, right?
Yeah.
Your management team as well.
Oh, yes.
That's very important. That's key. Like I said, the credit worthiness, your cash flow, there's internal and external forces, right? So
Yes.
when you're talking about financials, you want to look at your financial ratios, right? Your debt service coverage ratio, your leverage ratio, profitability, liquidity. Okay, we talked about cash flow, working capital. All of those things have to be at least on a positive trending wise, right? Well, I had a client that was trying to get a loan and was in the negative. So
Mm-hmm.
like was working at was operating at a loss, and I had to very kindly, gently let them know that a bank is not going to lend to a business that's working in the negative. So those are internal forces, right?
Right.
What is your management team, and what are you doing with the sales and everything that's happening in your business? External forces can be we talked about, you started talking about trends, right? What are there positive trends in your industry? Industry and economic trends, and compliance and regulatory issues as well. So
Yeah.
banks will look at that to see if you are at a higher risk or lower risk, because the bank wants to lend to lower risk clients versus higher risk clients.
Yeah. So let's let's just take a look at I'm going to assume that people have some basic understanding of finances, but what are the statements that a bank will look at from your experience? What statements are they going to ask business owners for?
Sure. So the typical three that they'll ask for is the balance sheet, income statement, and cash flow statement. If you're a bigger company, they may ask for maybe a statement of shareholders' equity to see what's happening there with the equity of the company. They will also look at the notes to the financial statements as well,
Yeah.
to see if there's any indicators that there might be red flags or things like that. They obviously, your historical wise, they'll look at basically those three financial statements.
Yeah, and and I know they'll ask for some other things. And it was my experience. I was a banker in my previous life with Bank of America and US Bank. So no matter how much I asked the business owner for, and I'd send it to underwriting to look at, they always asked for more information. But typically it was things like maybe an equity statement, or maybe a debt or liability schedule. So don't be surprised if you keep getting asked for more and more information. And today, from my experience, banks are looking not only at the business financials, but they tend to look at the personal financials as well. So a lot of the business owners I worked with, that when we worked on being bankable, we would have have their accountant have the business financial statements, but also a personal financial statement to go along with it, because you are going to be asked, again, if it's beyond just basic line of credit. So a lot of times those lines of credit, they can just do with a credit score. However, if it's a little more complicated for equipment financing or inventory financing, working capital, or any other type of financing, then they may ask for more information on the personal and business side.
Mm-hmm.
So from your experience, I really like this example of, if you took a look at their financial statements and you said, well, we're probably not a good candidate for the bank, right?
Mm-hmm.
So I've had many of those conversations, because most of the people who would come to see me at the SBDC
Mm-hmm.
had been turned down by the bank.
Mm-hmm.
Now, I just had a conversation with one of our bankers who is affiliated with camps. And I just said, when I was in banking, I was turning down 7 out of 10 loan applications. So when people came in and applied and we took a look at it, 7 out of 10 were being denied. And they told me that was about their same numbers today. So in other words, for a majority of businesses, bank financing is a little bit out of reach. So that's why I think it's important to take a look at and say, you know what, I'm going to position my company so that it's always bankable.
Mm-hmm.
So let's just talk a little bit about the numbers that a business executive team needs to look at to know that they are bankable. What are some of those numbers from your experience?
Going by industry numbers, if you're looking at your industry, like, know what's happening in your industry, number one, right? You besides being beyond being bankable, you have to know what's going on in your industry. And if your numbers based on the industry are worse than industry, like, that's not going to be good for your business, right? If they are a little bit better, then obviously that's going to give you a higher chance of getting a loan, right? You're doing something right. The debt to service coverage ratio, over a 1.0 would be preferable because you're able to cover your debt with your net operating income.
The industry average is there. Most businesses that I've worked with, they don't know what those industry averages are. So that's something you typically have to check with your industry associations. Sometimes they have that. Sometimes your accountant can look that up. They have access to industry averages, but most banks and bankers are able to research, because when they make their decision, they're going to make their decision, part of that decision, on how are you performing compared to the industry. So that's something you can go back to your banker, your accountant, or an industry association, or maybe you could Google it too, but to get an idea of what those financial averages are for your industry. So, but I think that was a really good tip, and something we don't typically think of, but it can affect how the bank looks at you.
So the debt service coverage ratio, anything over a 1 suggests that your company is able to cover its debt with the net operating income. So the income that's coming in is able to cover that debt. And that puts you in a positive light with lenders, with financial institutions.
And this is one that I think business owners don't look at at all, because it's very complicated. But what you're kind of saying is, if you look at the total debt payments, and there's different ways to look at that in terms of principal and interest. But if you just take the principal and interest payments and total that up for your business, and then look at your net cash flow, right, which you could get from your cash flow statement. And so on an annual basis, you take your annual debt payments and compare that to your net cash flow. So you're just saying, if there's $1 of debt payment to $1 of net cash flow, then you're okay. That's not great, but it's okay. But it would be stronger if you're, say, a 1.2 or 1.3. Then so if you got 1.2 or 1.3 of net cash flow to debt coverage, the bank will say that's good. That's really good. So I just those were numbers that I would often calculate for my clients, just because it's something they don't normally think about. But it was kind of surprising how many of them didn't have a positive debt coverage ratio. So anyway, that debt coverage ratio is something that you can kind of keep an eye on, is when you look at the end of the year at your because the bank will typically look at 1, 2, or 3 years historically, right? So again, we're talking about a positive trend of having more cash flow available at the end of the year than annual debt payments.
Any kind of leverage ratio. So debt to equity. So how much equity you have versus how much debt. You touched on it a little bit earlier, where equity is more expensive than debt, right? Once you pay off a debt, it's gone. You can't pay off your investors as easily. So you share that risk and that reward as well with your investors. So you want to look at your profitability ratios, right? Your return on assets, things like that. You want to look at liquidity ratios, right? Your current and quick ratios. You want to know if you can meet those liquidity ratios, basically let you know if you're able to meet your short-term obligations, right? And yeah, I would say those would be the best ratios to look at.
You know, the business owners I worked with who were interested in this topic of being bankable, right? They would actually have a sheet of paper that would have these ratios on them, and it'd say like 1.2 debt coverage ratio, right? Just so they knew what to look for. So a lot of times when people would come to me and say, you know, I want to get a bank loan, I'd look at their balance sheet right away and compare their total liabilities to their total equity. And if the total debt was, you know, over three to one, $3 of debt to $1 of equity, I would say, you know, we're going to be challenged with the bank. And 4 to 1 was like the red line, to never go over 4 to 1. So a lot of times with banks, we were talking to them about compensating factors, right? So we would say they have a really strong debt coverage ratio, they have really good working capital, which means that your current liabilities are stronger, bigger than your current liabilities on the balance sheet, right? So these were things that we would look at, but just to kind of keep in mind, 1.2 on your debt coverage ratio. No, usually try to be no more than 2 to 1 on your debt to total liabilities to total equity. And then you talked about like the return on assets, and these were some of the profitability measures, right? Return on investment, return on assets, return on sales could be other. So these are the return on things, but essentially you're looking at your profit margins. This is where the industry averages kind of come into play. So anyway, yeah, these are really good guidelines, you know, for business owners to think about. So from your experience, and a person's looking at a bank loan, but a lot of times when they look at their financial statements, this is all very confusing, which to me is a really good reason to go talk to Brenda before you talk to the bank.
That's definitely one of the things that SBDC does. I love numbers, so if you hate numbers, just come my way.
Yeah.
So yeah, we can help you with things like financial analysis and planning. We can't do it for you, but we can definitely educate you and put you in a better place. We can give you you know, business advising advice, like, you know, what we can't make the decision for you, but we can definitely look at those numbers and help you read those financial statements, because they're telling you a story and we can help you read that story a lot better.
Brenda, that was such a good point, because what a lot of people don't like about going to the bank is that the banks tend to understand, or the bankers tend to understand their financials better than they do. Not always, but sometimes this happens, right? So you want to be ready to explain the story of your financials to the banker. And with manufacturers, they get a lot more complicated financial statements because of inventory, because of work in process, because of accounts receivable. It can really change the complexity of the conversation. So I think by talking to the SBDC before you go to the bank, you're going to be in a position where you can talk about, you know, what does your inventory, you know, especially, you know, inventory compared to some of your other ratios, where's that at, your accounts receivable, your work in process, and how is that affecting your working capital, blah, blah, blah. So those conversations, it helps you be ready for the bank when they talk to you about this and say, well, you know, we noticed that you have a lot of, you know, inventory that's not moving. Well, now you're ready for that conversation, right? So and also I think it could really help with the structure of the debt too. That's something that I think, Brenda, you could really help somebody prepare in advance for what kind of funding do I need? Because from a banker's point of view, they don't look at a loan as a loan, but they look at different things like a line of credit, or if you're funding inventory, if you're funding working capital, or if you're funding an asset or equipment or a building. They look at all those as different instruments, essentially.
Yeah, different banking products for sure. Three things that are really, really important, I would say, are watching those capital expenditures, right? You know, what kind are you getting a loan for these huge capital expenditures? Is that going to be, are you at a point of your business that you can scale to, let's say, if you're moving to a bigger piece of equipment or something, is your business at a point where that would make sense for you? Another thing to look at is your accounts receivable, right? It's great if you're making sales, but if you're not turning, if you have a lot of clients on or customers on credit, that accounts receivable needs to be moving. And another thing is that goes along, accounts receivable goes along with that cash flow, right? Is that cash flow moving expediently towards your business? So if you're getting a lot of sales, but your accounts receivable aging is getting bigger and bigger and bigger, that's a red flag as well. So not just keeping track of that inventory, but also keeping track of those expenditures and where the money's going.
And that's another really good reason to talk to the SBDC, because these are the kind of conversations you can have and you can understand the situation, because sometimes things just start to happen and you don't even see them happening. But the numbers make you very grounded in reality. That's what I really like about the financial side of business is you're not doing stories in your head, you're seeing the actual numbers. And it can be so helpful. Also, Brenda, in my experience, a lot of companies aren't really good at being ready for that loan conversation, meaning they go in, they apply for a loan, but they don't have their financial statements ready. They're not ready for questions about how all of this works or interrelates. Mm-hmm. Do you have any advice in terms of like a best practice, say with their accounting firm, or maybe they have their accounting team, they have a team of accountants in their own company, or they're using an accounting firm, but how up to date should the financial statements be from your point of view?
Well, so there should be your accounting department, whether if it's internal or external, should be doing a month end process, right? So every month, at the end of the month, the books are being closed, which means that all the transactions are being tick tied, making sure everything was recorded, making sure everything makes sense. You don't want to get to a point where you're leaving that for each quarter or each year end, because it's just, especially with manufacturing, it's just a nightmare. Absolutely. So every month, as with especially a manufacturing company, you should be having meetings about your financials, right? Knowing what's going on in your business is just critical. It's critical for your decision making. It's just, sooner even more, but I would say at a minimum monthly, because your books are being closed on a monthly basis, or should be closed on a monthly basis, and you should know where your business is at.
So typically, and I really like your recommendation to have a regular financial meeting, maybe it's once a month, at least once a month, but you should be having the financial reports from last month, I think no later than mid-month. Mm-hmm. So if we're November 15th, we should be receiving October's financial statements. And, if there's some ratio slipping, if your accounts receivable days are moving out, or your working capital is thinning out, or if your debt ratio is getting too big, these are the kind of things you should be able to see and then take some action on, which was going to be my recommendation. If you find yourself in a position where you're not sure you're bankable, or a bank has told you you're not bankable, this is another really good reason to go to the SBDC, so you can actually have these kind of meetings and questions and take a look at it. A lot of businesses could benefit from just having these kind of work on your business meetings.
I have dealt with some companies that they're making a lot of sales, and then actually very common is there are businesses that have come to me, multiple businesses, where they're like, oh, we're making all these sales. I don't get it. I don't see the money in the bank, right? And it's going through those financials and understanding what's going on in the business. And part of that is being timely and recording those transactions as well, because a lot of times it's either the business owner is not paying attention to what's going on in the business, or the transactions, by the time the transactions are put into the system, it's you can't react, you can't respond to those changes in your business. So
I'll just mention that years ago as a banker, I had a client who outgrew his accounting system and his accountants. He actually just fired his whole accounting team. And I told him, I said, I think that's a mistake. His personal income at that time, the business owner's personal income was well over $1 million a year. And he said, no, I know my numbers. I know where they need to be. And he said, I can fly blind for a little while. Well, it took him 6 months to get the right system in, to get the right people in. And by that time, he had already lost like $3 million because he wasn't keeping an eye on the finances. And it took him, we worked with him for another 3 to 5 years before he recovered from those losses. So, this idea of flying blind or not looking at your financial statements has always had an unhappy ending.
Yeah, yeah. Don't go by emotions. Go
Yes.
by the numbers. The numbers never lie.
And
The
then don't
numbers
think you know
never
the
lie.
numbers,
Mm,
without the statements. So I think it's
absolutely.
really important to keep that regular eye on your financial statements.
Yeah. I remember so I've had I've had different kinds of jobs, including being a federal government contract auditor. And I remember auditing one company, and the business owner, it was a privately held company, and he was actually in manufacturing as well. He I was auditing him on a progress payment audit, and he told me, I said, well, a progress payment audit is basically, if you're unfamiliar, it's where they get paid based on the progress on the contract. And he just straight out told me, well, I know exactly where I am, where the business is in my head. And I was like, okay, well, I'm not seeing it in the numbers, so I need to see it in the numbers. And that was kind of a difficult conversation, because when the numbers were actually put down on paper, he was way off target. So yeah, that
That's never
just,
fun.
yeah,
No,
it's never fun. Never
no.
fun.
I think that I'm advocating for manufacturers to build a strong relationship with their bank and their accounting team, if it's the accounting team or an accounting firm, depending on how they work that. But I do think that having open conversations with your banker about your financials, but having somebody like Brenda at the SBDC that you can have a preparatory meeting, you can kind of see, here's my numbers, here's what's going on, can be very, very valuable. And if I could say again, how much does it cost to go to the SBDC?
It's it's no cost. And
Which is great. I love that.
just to add on to that as well, out of all the advisors that a business owner has in their life, we are the only ones that don't hold a stake in your business. So we can be honest with you, have that open and honest conversation, look at the numbers, and tell you what's actually happening.
Yeah, I really appreciate this kind of detailed conversation. I just want to mention that if, as a manufacturing company, you're looking at it and you're not sure if you're bankable, or if you happen to get turned down for any loans, I would highly recommend getting a hold of Brenda at the SBDC. So, Brenda told me before we started this that if somebody had interest in just questions, even, you can email Brenda, and I'll put her email in the description of the video, so you'll find it down there. And I'll put a link to the SBDC where you can schedule an appointment with Brenda or 40 of her colleagues, depending on where you live. But the level of conversation that we've just had, Brenda, I think they would have with any other SBDC person, because you guys are certified, you guys know the stuff, you live it, eat it, breathe it. I remember those days. So
Yeah.
in addition to financial help, actually the SBDC could help with many other issues, and that might be marketing, it could be export, it could be market research. I know that you guys have a market research arm. Now I understand they're backlogged right now, so I guess that that's up and down at times. But again, if you have a market research request, there you can put that through the SBDC. So the SBDC, the Washington SBDC, is really good at helping businesses solve their problems to get to that next level of their business. And I highly recommend them from my own experience, and from, I know, the hundreds and even thousands of businesses that you guys have worked with. So Brenda, is there anything else you want to say before we tie this up?
BDC is here to help. We are a passionate group, a passionate network of experienced business advisors, and we just love the mission of helping small businesses grow. So come and contact us, and we'll be happy to help.
Brenda, I really appreciate this time today. Appreciate your background, your expertise, and your passion for helping businesses grow.